I'm Gloria Ledoux here on the CU Compliance Connection by League Info site, bringing you the Compliance Outlook for a review of the laws and regulations that will be impacting your credit unions in the first and second quarter of 2018. Wait, did I just say 2018? What happened to 2017? Anyway. Starting off in the first quarter, as we do each year, I want to make sure to touch base on all of the annual updates to the thresholds that take place so that credit unions can make sure their systems, policies, and procedures are compliant. We'll then touch base briefly on the HMDA changes that became effective on January 1st, and then spend a few minutes talking about the CFPB's rules impacting payday lending. Then, although not effective in the first quarter, it was effective when released on December 14th, 2017, we want to touch base on the Department of Defense's interpretive rule on the Military Lending Act. Moving right along, we'll finish the first quarter by talking about the two notcher rule changes that may impact credit unions in March. For the second quarter, we will briefly touch base on the second set of changes to the mortgage servicing rules, which become effective on April 19th. And finally, FinCEN's customer due diligence rule, which becomes effective for credit unions to comply with on May 11th. We've got a pretty full agenda, so let's just get started. We think it's important to highlight all of the annual updates for credit unions each year as a reminder, just to ensure the policies, procedures, and lending platforms are up to date with all these new thresholds that become effective on January 1st each year. We know a lot of credit unions rely on their systems to indicate whether a loan is considered, say, a qualified mortgage or high cost. Therefore, it's critical to ensure these thresholds are updated in those systems so they are not providing incorrect information and causing the credit union to be non-compliant. Let's kick it off with the Home Ownership and Equity Protection Act, or HOEPA, which governs high-cost mortgage requirements. If the credit union is originating a mortgage that is considered high cost, the credit union must provide specific disclosures, limit certain transaction terms, fees, and practices, and utilize specific ability to repay requirements and ensure the member has home ownership counseling. As with many of the CFPB's regulations, certain thresholds adjust each year in accordance with the Consumer Price Index for all urban consumers. For HOEPA, the CFPB adjusted the points and fees threshold to determine if a loan is considered a high-cost mortgage. So if the credit union underwrites loans with points and fees that exceed these thresholds, they will be considered high cost and subject to the additional restrictions. Some credit unions may be eligible for an exemption from the escrow requirements for higher-priced mortgage loans. Each year, the CFPB adjusts the asset threshold, which for 2018 is $2.112 billion. In addition to the asset size threshold, there are other qualifications that credit union must meet to be exempt from these requirements. So credit unions should make sure to review them all before they discontinue offering escrow accounts to covered loans. As a reminder, generally, the rules require credit unions to maintain and establish escrow accounts for first lien, higher price mortgage loans for at least 5 years. Higher price mortgage loans also have certain appraisal requirements, which are detailed on this slide. However, there is an exemption for loans under a certain threshold, which is adjusted each year. For 2018, higher price mortgage loans under $26,000 would be exempt from these appraisal requirements. For a loan to be considered a qualified mortgage and receive the safe harbor protections, the loan's points and fees must not exceed certain thresholds. These thresholds typically increase each year. This slide illustrates the thresholds for 2018. Credit unions should also be aware of these safe harbor penalty fee limits for credit cards. Thankfully, there were no changes made to these thresholds from 2017. As part of Regulation D, credit unions are required to maintain certain reserves based on the mix of deposits at the credit union. The threshold amounts for these reserve requirements adjust each year, and for 2018 are listed for reference in this slide. Wrapping up our annual threshold changes are the IRS limits for health savings accounts, or HSA contributions. For 2018, the limit for an individual plan is $3,450, and the limit for a family plan is $6,900. All right, moving right along, let's talk about some of the other regulations that become effective in the first quarter. I don't want to spend a lot of time on the changes to the Home Mortgage Disclosure Act, or HMDA, because we have a whole separate Compliance Connection video that you can watch to get more details. Let's just highlight some of the main points. First, the definition of a financial institution changed, so we will discuss briefly how that may impact credit unions and their coverage. We'll also talk about the changes in the types of loans that are required to be reported under the rules, which is now based on a dwelling secured standard. There are a significant amount of new data points and revised data points that the credit union now needs to collect. Changes were also made on the requirements to collect and report ethnicity, race, and sex of the applicant, which also prompted additional changes to Regulation B, which implements the Equal Credit Opportunity Act. There were changes to how credit unions report their HMDA data, which is now electronic. And to sum it all up, credit unions will have new lobby disclosures and will direct credit unions requesting HMDA data to the CFPB's website. Credit unions only need to comply with the HMDA reporting requirements if they are considered a financial institution under the amended rules. As you can see, the asset size threshold for 2018 is $45 million, which increased from $44 million in 2017. We also have the location requirement to determine if the credit union had a home or branch office located in a metropolitan statistical area. The loan activity requirement is that during the preceding calendar year, the credit union must have originated at least one home purchase loan or refinancing secured by a first lien on a 1 to 4 unit dwelling. There is still the requirement to be federally insured or regulated. And then lastly, the loan volume thresholds for closed-end mortgage loans and open-end lines of credit. If the credit union meets or exceeds either loan volume thresholds in each of the 2 preceding calendar years, the credit union is required to report those loans. So as of January 1st, 2018, the loan volume thresholds for closed-end mortgages is 25, and for open-end lines of credit, 500. Remember, these are separate tests. You only need to report on the types of loans that you meet the threshold for. So for example, if your credit union only meets the open-end line of credit threshold, you are not required to report the closed-end loans, only the open-end lines of credit. The transactional coverage under the new rules has changed. They are now based on a dwelling secured model. There are definitions in the new rule of what is considered a closed-end mortgage loan and an open-end line of credit under the rules, but both include the requirement to be secured by a lien on a dwelling. Keep in mind that a business purpose transaction that is exempt from Reg Z, but is otherwise an open-end credit under the regulation, would be considered an open-end line of credit under the HMDA rule if it is secured by a lien on a dwelling. A dwelling is a residential structure, and there is no requirement for that structure to be attached to real property or that it be the applicant or borrower's residence. So that may include second homes and vacation homes, investment properties, detached residential structures, cooperative units, etc. Credit unions are encouraged to review the regulation for more detailed information on covered transactions and those transactions that are specifically excluded under the rules in order to build compliant procedures and have compliant reporting. Although the applicant is not required to provide it, the credit union will be required to ask for ethnicity, race, and sex of an applicant, regardless of whether the application is taken in person, by mail, via the internet, or over the phone. These questions can be listed on the loan application form or on a separate form that refers to the application. The credit union also must offer the applicant the option of selecting more than one ethnicity and race, and must permit the applicant to self-identify using aggregate categories and disaggregate categories. If the information is not provided, the credit union must note that and then collect the information on the basis of visual observation or surname. The credit union does not need to use the disaggregated categories when identifying the applicant by surname or visually. Credit unions must utilize an application or separate form that refers to the application and allows the applicant to self-identify on a disaggregated basis and provides disclosures in compliance with the rules. The CFPB's long-awaited rules governing payday loans becomes effective on January 16, 2018. Credit unions scored a win here because they are exempt from the requirements of the rule if they structure their payday alternative loan product in compliance with the NCUA rules for federally chartered credit unions under 701.21. Don't worry, if you're a state chartered credit union, you are still eligible for the exemption if you comply with the NCUA rules. You have some time to review your program to ensure compliance. The actual compliance date of this regulation is August 19th, 2019. There is also talk of this rule being repealed, so keep your eyes open for that. However, it still doesn't hurt to review your Payday Alternative Loan Program, whether you are a state or federal charter, to see if you are complying with the NCUA rules. Credit unions have been asking the Department of Defense for clarification on the Military Lending Act, probably since the rule was published. Just recently, they published an interpretive rule that did address one point that credit unions have been trying to receive clarification on. Currently, the MLA, or the Military Lending Act, excludes certain loans from their definition of consumer credit. Specifically, any credit transaction intended to finance the purchase of a vehicle when the credit is secured by that vehicle being purchased. So credit unions were concerned about situations involving negative equity and if those transactions still met the exemption, since the borrower was also financing that negative equity. However, with the interpretive guidance, we know that new auto loans that have negative equity are still considered exempt transactions and not covered under the rule. There are some situations that would cause a transaction to lose that exemption, so credit unions should pay attention to those and ensure their procedures and processes are compliant. Coming to an end of our first quarter reminders, credit unions should be aware that Phase 3 of the same-day ACH NACHA rule changes becomes effective on March 16th. In Phase 3, credit union RDFIs, or receiving depository financial institutions, will be required to process same-day ACH credits and debits by 5 p.m. their local time, as opposed to the end of their processing day, which is what the rules are right now. Again, this NACHA chart is a helpful tool in identifying the differences in the implementation of the same-day ACH. Now, another NACHA amendment that became effective in the third quarter of 2017 is related to third-party sender registration. If your credit union is an originating depository financial institution, or ODFI, you are required to identify and register your third-party sender members. Remember, as an ODFI, even if you do not conduct third-party origination, you are required to access the registry and acknowledge that in a statement to NACHA. Well, this amendment became effective on September 29th when the registry officially opened and became available. Credit unions have until March 1st, 2018 to complete the registry. Remember, in order to comply with these NACHA requirements, the credit union should develop procedures to ensure that they are keeping that information that's on the NACHA registry up to date. The rule also contains some timing requirements that the credit union must follow after they become aware of these changes. Now we'll spend a brief amount of time reviewing the second set of mortgage servicing rule changes that become effective on April 19th. In a nutshell, the credit union will have to treat confirmed successors in interest as borrowers for the purposes of the mortgage servicing rules covered under Regulation X, or RESPA, and Regulation Z, or TILA. There are also some changes that credit unions will have to make to periodic statements if they have a borrower in bankruptcy. So let's touch base on these in a little more detail. The credit union will need to have policies and procedures in place to make sure that they are properly identifying and confirming a successor in interest. Once they have done that, they will need to treat them as a borrower for purposes of the mortgage servicing rules. For example, all of the notice requirements, periodic statement requirements, etc., that the credit union must follow for borrowers must also be followed for confirmed successors in interest. If the credit union is a small servicer, you still maintain the same exemptions that you did before, such as a periodic statement requirement, but all of the other provisions of the mortgage servicing rules that do apply to you as a small creditor will apply to your treatment and notification of confirmed successors in interest. There is too much to cover in a quarterly update, so we will do a separate compliance connection video covering these changes. However, in summary, credit unions should start developing their procedures for how they are going to handle requests or communications from potential successors in interest. There are timing requirements the credit union must respond by. There are also templates within the regulation that provide a safe harbor and potential exemptions that the credit union should research. Lastly, the periodic statement changes for borrowers in bankruptcy are extensive. Credit unions, if they aren't already, should be working with either their statement providers or internally to develop alternative statements for borrowers in bankruptcy. Lastly, to round out the second quarter, we have the mandatory compliance date for FinCEN's customer due diligence rules. Credit unions are required to identify and verify the beneficial owners of their legal entity members. Remember, the regulation provides for a certification form that credit unions can use or replicate to obtain the required information from a legal entity for those beneficial owners. Once the credit union obtains the beneficial ownership information for the legal entity, then the credit union needs to comply with their member or customer identification program to verify the identity of these individuals. Along with those requirements for legal entity members, the rules formalize the requirements for credit unions developing risk-based procedures for conducting ongoing member due diligence. Hopefully that was a helpful overview of all the regulatory changes we need to have on our radar for the first half of the year. As always, thank you so much for joining us at the CU Compliance Connection. Remember, through your league or association in CUNA, you have a tremendous amount of compliance tools and resources at your fingertips, most of the time at no additional cost. We're here to help you at the CU Compliance Connection by League Info site.